Yesterday we have talked about the cash management. Uh, to manage cash, there are two models, mainly Miller-Orr model and BAT model, Baumol, Allies, and Tobin model. And we have done a small sum on BAT model. Today we will discuss uh, and and we have done a small this sum, and I hope all of you got the idea behind the BAT model. And in this slide I have given you two more examples, and it is not in this example uh, we have nothing new, right? It is similar to the sum we have done yesterday in the last class. For your right, I give you 3 minutes. Can you find the answer for the question 1, example 1? Have a try on this. Please read and please read the answer. Right? Are you okay? Here nothing new. We have to find the optimum amount of cash balance to keep the organization, and so annual demand is given here. How much? Limited has a total cash requirement at 20 million, right? 20 million is annual demand of cash, and opportunity cost is 15%. So in this question, they directly given us the opportunity cost of fund. So yesterday's sum, we have to find the opportunity cost, right? We have to find the opportunity cost, but here they have given directly, so no issue. The company will have to incur 150 per transaction. So transaction cost 150 when it converts its short-term securities to cash. Determine the optimum cash balance. How much? Anybody have found this? Any answers? Any answers? Any answers, please? Okay, we don't want to waste our time, and please do it as your take home work. And question number 2 also same thing, but here the cash requirement is given you on daily basis per day, and 7 days a week. So all 7 days in a week. So it's mean there are 365 days in a year. So to calculate the annual demand of cash, we have to multiply this 100 rupees, 100 US dollar into 365 days. The interest rate is 5% and fixed cost of refreshment cash balance is 10%. Here there is they have given us only one interest rate, therefore we have take this 5% as opportunity cost of holding cash. So nothing new here. And what is the optimum cash balance and what is the total cost? So by using the BAT model, we can find out the optimum cash balance, and to find out the total cost, we have to find holding cost, so opportunity cost, average case into the rate of opportunity cost, and plus transaction cost. So we have to find out how many transactions in a year, and we multiply it by transaction cost per transaction. And we move to the next model, that is Miller-Orr model. Miller-Orr model. And here assume that if let unmanaged, if fund is unmanaged, what will happen? So if you are a financial manager in a company, you are you are never take care about that of cash. So what will happen? A company's cash balance would follow a random walk with zero drift. Right? Random walk means nobody can predict the cash movements. So you know that the cash is one of the most important liquid asset in organizations. The efficient management of cash is very important for the successful organization. And to manage the cash successfully, efficiently, Miller-Orr have developed a model. In that model, they have set 3 level of cash balances. The cash balance is allowed to wander freely between the upper limit and the lower limit. So they have set the maximum limit is called upper limit, and the lowest level is a lower limit. And in between, we have to find a balance called optimum cash balance requirement, or we call it it's a return point, right? In inventory management, you have studied the stock control. There's a maximum stock level, minimum stock level, average level, EOQ. So that kind of stuff similar to that, but the equation is different, totally different from inventory management. And if cash holding reaches upper limit, the management intervenes by withdrawing the amount equal to upper limit minus the return point, optimum point. So they're withdrawing the amount, the difference between upper limit and optimum limit, optimum amount dollars to return the cash balance to the target level, right? So if the money reaches at the upper point, what they do is they convert, right? They withdraw the money and they invest in short-term securities, in short-term investments, and the cash balance become to the optimum level, target balance, right? Return points at target balance. And if cash balance reaches at the minimum point, then they will again they will return back the cash from the securities. They are trying to sell the securities, short-term securities. So if the cash balance reaches lower limit, management intervenes by injection. Injection means we convert the securities into cash. So the amount equal to the target balance minus the lower limit. So dollars to return the cash balances to the target balance C. So let us define, let us explain using the graph. This here in the vertical axis, the cash balance, amount of cash, and horizontal axis we have to put the time period. In it may be in days or in weeks, months, whatsoever in it. Right. Here they start from, yeah. So they are not intervening by the management because the fund is uh, below the upper limit. Once the cash balance reaches the upper limit, here, so for example, uh, upper limit is 100,000. Upper limit is 100,000, and the optimal limit is say 25,000, so 30,000, right? This balance may be 5,000, right? Here 100,000, here 30,000, here 5,000, right? Once the cash balance is reaches this point 100,000, what they do is the management convert the securities, sorry, convert cash into marketable securities. Say get 100,000 now, at this point 100,000. So our optimum balance is 30,000. So how much the difference? How much difference? 100,000 minus
70,000.
put. So they will sell. They will buy, or they will put the money into the fixed deposit, or they will buy treasury bills or whatsoever marketable securities. The amount equal to 70,000, and this balance here it's become 30,000, and again it will the management will allow to move the cash in between the upper limit and the optimum limit. Once right, and once the level of cash balance reaches at the minimum point, it's mean the bottom lower point, and management come to intervenes, and then they will convert the marketable securities which already purchased by the management, and they convert into cash, right? They sell the marketable securities, and they convert into cash, convert into cash. So marketable securities convert into cash. Then here is a 10,000, right? The target balance is 30,000. Then with what amount of marketable securities they are going to sell it? What's the amount here? 10,000 to 30,000. How much? It's equal to 20,000, right? So 20,000 value of marketable securities will be sold out to get money back, and it's work randomly. So the money will move up and down in between upper limit and lower limit, right? So here U is the upper limit and L is the lower limit. The target cash balance is C, and as long as cash is between L and U, upper limit and lower limit, no transaction is met. That is here in between there is no transaction. There is no selling and buying of securities. Once it reaches upper limit or reaches lower limit, then only the manager will interfere on this cash management affairs to whether convert the cash into marketable securities or marketable securities into cash. So it depends on the point it reaches, and it can be explained in this picture also. Here the cash balance at time, they set a low balance here and the upper limit here. So once the point A where the cash balance reaches at upper limit and the firm buys securities, right? They have additional cash, surplus cash, so therefore they purchase securities. Once the firm's cash balance reaches point B, it's a signal that the firm's in the cash deficit position. So therefore, the company try to sell this firm securities, right? The thing is, we have to calculate the upper limit and return point. Upper limit and return point, we have to calculate. So how do we calculate? That's the way of calculating. The tool for calculating these points is Miller-Orr model, that's equation, right? So lower limit, most of the times the management have to decide, right? The lower limit of cash balance management will decide, but the return point and upper limit is decided by the formula. So this is the formula, Miller-Orr model formula. Say L, so is what is equal to lower limit. It is normally set by the firm, set by the management. And C is what? C is the return point. Return point means optimum cash balance. It is equal lower limit plus 3 over 4, 3 quarters, right? 3 quarters into F is a transaction cost. F is a transaction cost, and it is a variance, right? It's a variance, standard deviation square, right? And a rate mean what we call what rate of interest. Here the rate of interest, and here 1/3 root, right? Here then we have to, the formula to find out the upper limit is 3 into optimum cash balance minus 2 into the lower limit. Then average cash balance equal 4 into optimum cash balance minus the lower balance and divided by 3, right? And we will look at an example, right? uh, Here assume that the lower limit is 0, right? The company policy is having the lower limit, the cash amount equals 0, lower limit equal 0, and the transaction cost to convert the securities into cash, or when they buy securities they have to spend 10 rupees as a transaction cost, and I is the rate of interest. When you deposit the money into the bank, they will give you this amount of money, percent per month, right? It's a monthly, right? It's very important. So per month, 0.5% per month, and the standard deviation of monthly cash flows is 2000, right? So in the horizontal axis, the time, we have to put the time. The time interval is month, right? Not daily, right? Not annually, it's a month, right? So they are managing cash on monthly basis, right? Then how do we calculate? How do we calculate the optimum balance? Optimum balance mean the return point. C is the return point. Is equal. This is the formula, no? CL is a lower limit here. What's the lower limit here? How much lower limit?
0.
Good. And 3 over 4, it's constant. How much F? Value of F is $10, no? $10. And here is variance, not standard deviation. If they are given you standard deviation, you have to get the root, not root balance, square balance, right? You have to double it, not double, you have to square, right? in case of standard deviation. If they are given you variance, no need to work more. You can put that figure directly and divide by rate of interest. How much rate of interest monthly is 0.5%. 0.5% mean when we convert into decimal points, 0.05, 0.005, right? It's a percentage. We divide by 100. Here lower balance is 0, 3 or 4, transaction cost is 10, and the the variance, yeah, so standard deviation here. Standard deviation 2000 and divided by which one? So interest rate and 103. Then the optimum case balance becomes 1817. 1817. From this figure, uh, we can calculate this. So upper limit. Upper limit equal. So formula 3 into optimum balance minus 2 into lower balance. So in this question, the lower balance equal to 0. So this part will become 0. Then this part only remains. So 3 into optimum case balance. That is what. So optimum case balance is 1817 into 3. So therefore upper limit is 5451. 5451. Then we can draw the Miller-Orr model for case management, right? Can you draw it? Anybody of you can draw the limit, right? If you want, I can draw it for you, and we can calculate average case balance. That is how much? 4 into optimum case balance. Here, see, right? Minus lower balance divided by 3. Here 4 into optimum case balance minus lower balance is 0 and divided by 3. So that is 4000, 2423. So when we plot it on the graph, then here we already calculated how much lower balance became here. 0 balance, 0, isn't it? 0. Therefore lower balance become here. And how much return point? How much return point? Anybody? Return point here, what's the value? 1817. 1817. And upper limit 5451. And the average balance in between this point here, in between this point, in between upper limit and return point, right? Any questions? Any questions? All right, and so this is another formula to that. So this is here. First, the return point equal, it's mean optimum balance lower limit plus 1 over the spread. Here the spread mean how to calculate spread here, right? And you can go through this slide, and so these are the steps to calculate to draw the Miller-Orr model. So step 1, set the lower limit for cash balance. This may be 0 or it may be set so at some minimum safety margin above zero. So some of, for this example, this company set the minimum cash balance as zero, and for some companies can set as a lower balance is 5,000, 10,000, 100,000. It's based on their requirement. It's decided by the management. Then once they set the lower balance, lower limit, then they go to the second step, estimate the variance of cash flows. For example, from the sample observation over 100-day period. So you know how to calculate the standard deviation and variance. So I hope that you have already studied uh, uh, portfolio, no, portfolio management, stock, how to calculate standard deviations, mean risk of a security, risk of security, and the standard deviation of the security. There is normally the risk of the security is measured by the standard deviation. So the like that way, that method, you can calculate the cash requirement, estimate the cash, but estimate the variance of cash flow, and the and third step, note the interest rate, right, and transaction cost, interest rate and the transaction cost. For sale or purchase of securities, right, the late payment transaction cost is assumed to be fixed. So transaction cost is fixed. To buy or sell an security, the transaction cost is fixed. Compute upper limit and the return point from the model and implement the limit strategy. So this is very simple, right? It's like what inventory management. So in the inventory management said the maximum stock level, minimum stock level, average EOQ level, reorder point. So that sort of stuffs, like, but the computation is little bit different than that. And right, here's one question for you. So here the following data applies to the company. The minimum cash balance is 8,000. The variance of daily cash flow is 4 million. Equivalent standard deviation 2,000 per day. The transaction cost of buying or selling securities $50. The interest rate is 0.025 per day, and you are required to formulate a decision using the model. Can you calculate this one? Can you calculate? Please have a try on this. I'll give you 2 to 3 minutes. Please have a try on this. And please post your answer in the chat box. Any answers? Right, you can do the sum and please post your answer, and you can't spend more time, so it's nothing new. And we will move here the Miller-Orr model implication. So consider the effect of uncertainty. So the uncertainty is measured by standard deviation or variance, right? So consider the effect of uncertainty through variance in net cash flows, right? Net cash flows. So net cash flows mean cash inflow minus cash outflow equal cash balance, and we have to get net cash flows of last 100 days, 100 days or 1 year, and you get the standard deviation. That's a variance, right? So in case of stock return, we call as what? We call as what? Standard deviation of stocks with stock return equal to what? Okay, students, please respond. Any answers? Standard deviation of stock return equal to what? Any answers? I hope all of you are expert in finance. It's a risk, no? Risk. Standard deviation of return equals risk of the security of the stock. Likewise, if the standard deviation is high, it means the stock return risk, the risk is high. Risk is standard deviation high, mean risk is high. Standard deviation is the measure of risk of security. Likewise, in cash management, standard deviation is the, if the company having higher level of standard deviation, it means high risk. All the times the cash balance are fluctuate, right? The higher the standard deviation, higher the variance, the greater the differences between optimum cash balance and lower cash balance, right? And the higher the variance, the higher the upper limit, right? The upper limit will be more, distance is more, and the average cash balance. So there are 4 balances. First optimum balance and lower balance. If the variance is high, right? The variance is high, it will, right? The distance between here, the distance will be high. If the variance is high means here this line will be go this here, and this line will down here. So here the variance is high. The variance is, the standard deviation is lower, it means lower standard deviation mean then this line become here very close to return point, and lower limit line also very close to return point. This means spread, the spread is very low, right? That's a thing here mentioned. So the consider the effect of uncertainty, it's evaluated through variance in the net cash flows. So the higher the standard deviation or variance, the greater the difference between optimum balance and the lower limit, and the higher the standard deviation, the higher the upper limit and the average cash balance. All things being equal, we assume everything are equal, the greater the interest rate, when interest rates increases, we can lower the optimum cost. All things being equal mean there is no changes in here upper limit and lower limit. Here the greater the interest rate, the lower the optimum balance return point, and the greater the order cost, right? The higher the return point. So here the both interest rate is equal to opportunity cost, isn't it? Interest rate is equal to opportunity cost of holding cash. So when we are keeping more opportunity cost, we have to reduce the cash balance in our hand. So logic is matched here. And when the greater the transaction cost, and we have to keep higher amount of cash balance. Here the greater the order cost, this mean transaction cost, and the optimum point, the return point of cash balance should be high, right? To minimize the transaction cost. And here Miller-Orr model with overdraft, OD. You know what do you mean by OD? It's mean when companies, business organizations needs fund, uh, if they are facing fund deficit, they go for a bank to get an overdraft, right? A loan, short-term loans, kind of short-term loan by drawing a check. So it is available only for current account holders, right? So you have to understand these things. So when we compare the interest rate on short-term investment is less than the cost of bank overdraft, right? So if you put your money into the bank, say for example you have put your money into fixed deposit, maybe 5%, right? And the overdraft, when you get loan from the bank, definitely it's higher than the deposit, fixed deposit rate, right? Say it's maybe 8% bank overdraft. When you get loan, short-term loan from the bank in way of overdraft, you have to pay interest rate 8%. But if you invest money in that same bank, you will get 5%, right? But if you invest a security, you have invest in fixed deposit for a longer period, say 10 years deposit, fixed deposit, definitely the interest rate is higher than bank overdraft, right? So you have to understand the logic. Say in this example, we have put short-term interest rate is 5%, bank overdraft 8%. So yield on long-term investment, it may be 10%, 12%, or 15%. Definitely, it's higher than the cost of bank overdraft. So based on this logic, right? Based on this logic, uh, uh, right? We can understand this scenario. A dollar mean a money invested in short-term assets earn less than the cost saved by applying that dollar to reduce overdraft usage, right? If you put the money in the short-term investment, you are getting a lower amount of income as interest, and when compared with the bank overdraft opportunity cost. See the opportunity cost, right? The company invests nothing in the short-term assets, but and as much as possible in the long-term assets. It's mean that based on this uh, Miller-Orr model, they suggest that if we have extra money, surplus money, don't put your money in the short-term investment, but if you put that money in the long-term investment, it will earn higher income, interest income. But at the same time, if you face cash deficit, you can go for a bank loan, because the bank loan, when you get a bank loan, that earn interest, that we have to pay interest less than the long term. Say for example, here if you get the bank overdraft, we have to pay 8%, but you already invested in the long term investment, say they are paying 10% interest rate, right? So you can compensate, you can get a higher interest income from your investment, long term investment. From that income you can settle the bank overdraft cost, right, at 8%. The company invests nothing in the short term assets, and as much as possible in long term assets, while meeting its liquidity needs through using overdraft, right? So the advice is, according to this model, don't invest your money in short term securities, but you have to put that money in the long term investment, long term securities. When you are facing cash deficit, go for a bank overdraft, because the rate of interest we have to pay to that overdraft is less than the money you are earned from the long term investments. So this is the implication of the Miller-Orr model with overdraft. And we have to make some small adjustment in the formula to calculate optimum cash balance, right? Then so what is upper limit? Upper limit is 0. The overdraft upper limit 0, because they motivate us to invest surplus fund in the long term investment, right? So therefore upper limit is 0. There is no upper limit. And here to find the optimum point, return point, here everything are equal as same equation, but we have to make adjustment here. So here rate of interest means, say for example, in our example, assume that rate of interest is 10% in the long term assets. For the long term assets, bank overdraft is 8%. So you can get the 2% margin, right? 2% margin, opportunity cost. The opportunity cost only 2, and so others are same. So target overdraft level is 2 into 2 into return point. Here the D means the cost of bank overdraft, right? Cost of bank overdraft. And we have small example on this, right? So Beta Limited provides the following information about its liquidity, and the annual yield available on marketable securities is 12, right? Annual yield is 12%, and fixed cost of affecting marketable securities transaction is 1,600, and the standard deviation of the change in daily cash flow is 5,000. Management of Beta would like to maintain a minimum cash balance of rupees 50,000. And given the above information, calculate the return point and the upper control limit for Beta as per Miller and Orr model. Right? Right. Have a look at on this example. I will do it for you. Right. I will. Right. I can share my screen. Here without overdraft, no. Right. Can you see the Excel sheet? Can you see the Excel sheet?
Yes.
Okay. So we need information. What we need transaction cost. Transaction cost. How much? Transaction cost. Cost per transaction. How much?
1,600.
1,600. And opportunity cost. Opportunity cost mean the rate of interest.
12%.
Rate of interest is 12%. 12% per annum, isn't it? 12% per annum. But the question is very careful. The question is about what? The cost of effective marketable securities transaction 1,600. The standard deviation of the daily case balance, right? Daily case balance. And we have to convert this annual interest rate into daily interest rate. How we can do it?
We have to divide into 360.
Yes, good. 300. So assume that number of days in this year 360, right? Assume that the number of days in the year 60, and how much? My yield and the fixed cost of effective transaction, the standard deviation 5,000, standard deviation 5,000. We need standard deviation is equal 5,000 rupees. And what we need? That's all, no? Then we will do our calculation. First, what's the equation here? This is the equation. Right, C equal how much? First we will find out the optimum level. L how much? Lower balance? Lower balance?
50,000.
Lower balance is 50,000. Lower balance is 50,000. Right, and now we will find the C. Lower limit is 50,000, and here we will find this later. And 304 equal 304 mean how much? 0.75, right? Right? 0.75. How much transaction cost? How much transaction cost? And 1,600. 1,600 into standard deviation is 5,000. 5,000 and divided by divided by R. R is equal 0. Right? How much? and we have to get the 1/3. We get equal this figure 1/3. So this is how much? This is the spread, and right, the spread, and we have to get what? Lower balance. How much lower balance? L equal 50,000 plus 50,000 plus, and the spread. How much? Return point, how much? C equal 94,000, and upper limit how much? Upper limit equal 3 into optimum balance, this one, optimum balance 94 bracket minus 2 into lower balance 2,000. Then how much? 184,000, isn't it? So we have found upper balance, upper limit, and optimum point, and the lower limit. Any questions to ask? Any questions? Any questions? And do you have lectures at 10 o'clock? Do you have lectures? Okay, then we will wind up the class and we will continue from next. And meanwhile, please do this sum as your take home work, right? Xeon Limited, and then I will give you, so nothing new here, no, right? It's nothing new, so it's for your understanding purpose. You can do it by yourself, and we will start from plots is very small thing, right? And right, we will stop the class now, and I will send you the attendance link. Attendance link.